Hey everyone, welcome back to Corporate Decoder. Today, I.N.D.P has just filed its proxy statement for its 2026 annual meeting, and I am seeing some interesting salary structures that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. They are asking shareholders to approve their 2026 equity incentive plan, which could mean a significant number of new shares and a potential shift in how employees are compensated. So, Indaptus Therapeutics is getting ready for its annual stockholder meeting on the 10th of August 2026. One of the main things they want your okay on is the Indaptus Therapeutics Incorporated 2026 Equity Incentive Plan. Think of this as a way for the company to give out stock options and other stock-related rewards to its employees. Directors and consultants. The big idea here is to attract and keep talented people by giving them a stake in the company's success. When employees have stock, they are more likely to work hard to make the company's stock price go up because they benefit directly. This plan is set to start right after the meeting if approved. Now here is where it gets really interesting. The plan proposes to reserve a significant chunk of the company's stock for these awards. Initially, it is going to be about 10% of the company's outstanding shares. Based on what they filed, that is likely around 13.3 million shares. But that is not all. This plan has an automatic yearly increase built in every year from 2027 to 2031. The number of available shares will go up by 5% of the total shares outstanding at that time. This is often called an evergreen provision. It means the pool of shares for awards can keep growing. On top of that, the plan also has a specific limit for incentive stock options, or ISOs, which are a type of stock option with favorable tax treatment. This ISO limit is designed to not exceed that initial 10% reserve of shares, unless stockholders approve otherwise. Because they are putting this new 2026 plan in place, they also plan to stop giving out new awards under their old 2021 stock incentive plan. This means if shareholders approve the new plan, the company will no longer be making any new grants under the old one. They are also freezing any automatic increases to the share reserve in the 2021 plan. This basically consolidates their equity incentive strategy into this new 2026 plan. It is a move to streamline how they manage and award company stock. Now let's shift gears to another key part of the meeting proposals, the election of directors. The company is asking shareholders to elect David Nathan, Tim Ruan, and Johnny Fox Arrowsmith as Class II directors. These directors would serve until the 2029 annual meeting of stockholders, and until their replacements are chosen. This is part of a staggered board structure, which means only a portion of the board is up for election each year. This setup can sometimes make it harder for new ownership groups or activist investors to quickly change the board or management. The company's bylaws state that directors can only be removed for cause with a majority vote of the outstanding stock. Let's look at one of the nominees for director, David Nathan. He has a really extensive background. He has been on the board since January 2026. For over 15 years, he has run his own consulting firm, Nathan and Associates, helping public and private companies with their chief financial officer duties. He also served as CEO of Forcefield Energy Incorporated for a decade. His resume includes roles at PharmaNet Development Group Incorporated and Global Technovations Incorporated. Plus, he is no stranger to corporate boards. He currently sits on the boards of Sunshine Biopharma Incorporated and Phi Incorporated. He has also served on the boards of several other public companies in the past. With his financial expertise and experience with public companies, the board sees him as a valuable asset. Another nominee is Tim Ruan, who joined the board in April 2026. He is a seasoned financial executive with a career spanning capital markets, investment banking, and the biotech sector. He was previously the chief financial officer at Allocation Therapeutics. He held senior positions at major financial institutions like Goldman Sachs Incorporated and Morgan Stanley Asia Limited. His investment banking work involved advising on initial public offerings and complex transactions for healthcare and tech companies. He even has a Master of Science in Biotechnology, which ties in nicely with the company's industry. The third nominee is Dr. Johnny Fox Arrowsmith, also known as Yi Zhang. He joined the board in April 2026 as well. He is highlighted as an expert in intellectual property and life sciences. He is a partner at Shunhei, focusing on cross-border intellectual property matters, especially between the US and China. He has a lot of experience helping with intellectual property due diligence for investments and mergers and acquisitions in the life sciences. Before becoming a lawyer, he spent over a decade in scientific research, focusing on stem cell differentiation. He is a registered patent attorney and admitted to practice law in multiple states. His combined legal and scientific background makes him a unique candidate. Moving on to Proposal 2, this is about ratifying the appointment of Haskell & White LLP as the company's independent registered public accounting firm for the fiscal year ending the 31st of December 2026. This is a standard procedure, while not legally required for shareholders to approve. The board thinks it is good practice to get your input. Haskell & White LLP also audited them for 2025. The good news is there are no indications of any financial interests or connections between the accounting firm and Indaptus Therapeutics beyond their auditing role. However, a representative from Haskell & White LLP will not be at the meeting to answer questions. Let's quickly look at the fees paid to Haskell & White LLP for 2025. The company paid them about $205,500 for audit fees and an additional $73,555 for audit-related services. In 2024, the audit fees were a bit higher at $221,000 with no additional audit-related fees. Overall, these numbers seem to be in line with what you might expect for a company of this size to spend on auditing services. Now we're back to Proposal 3, which is a key part of the agenda, approving the 2026 Equity Incentive Plan. As I mentioned earlier, this plan is designed to attract and keep top talent by offering them stock-based incentives. The board has adopted it, but it needs shareholder approval to become official. The core idea is to give employees, directors, and consultants a reason to work hard and stay with the company by aligning their interests with those of the shareholders. This section really gets into the details of the plan. The maximum number of shares that can be granted under this plan is set at 10% of the company's outstanding shares on the day the plan takes effect, so if they get the go-ahead, that is potentially over 13 million shares reserved for awards. And remember that yearly 5% increase we talked about. That can add even more shares over time. The plan allows for various types of awards, like stock options, restricted stock, and other equity-based awards. These are meant to motivate and retain employees, directors, and consultants. This section is from the Audit Committee of the Board of Directors. They've reviewed the company's financial statements for the year ending the 31st of December 2025. They've discussed these statements with the company's management and with their independent auditor Haskell & White LLP. They've also made sure that the auditors are independent and have followed all the rules set by the Public Company Accounting Oversight Board and the Securities and Exchange Commission. Basically, they're saying they've checked the financials and are comfortable with them. Let's quickly look at who is running the show. The table lists the current executive officers. Junyi Dai is the Chief Executive Officer and Chairman of the Board. Yuding is the Chief Financial Officer. You can see their biographies and backgrounds if you need more detail, but these are the key people in charge. Now, for the part that often gets a lot of attention, executive compensation. This table shows how much the top executives were paid in 2025 and 2024. For 2025, Jeffrey A. Meckler, who was then co-chief executive officer, had a total compensation of $2,197,171. Walt A. Linscott, the chief operating officer, received $1,953,870. Michael J. Newman, the chief scientific officer, had a total compensation of $1,691,286. It is important to remember that these total compensation figures include salary, bonuses, and the fair value of stock awards. These stock awards are based on their value on the grant date, and the actual amount realized depends on the stock's performance later. You will notice that some of these execs are no longer with the company as of the filing date, which is common in the biotech world. Here we see the equity awards that were still outstanding for these executives at the end of 2025. For example, Jeffrey A. Meckler had a number of unexercised options with various exercise prices and expiration dates. This shows the long-term incentive structure that was in place for the named executive officers. These options are a big part of their potential compensation, but they only become valuable if the stock price goes up past the exercise price. This section details the employment agreements and what happens if an executive leaves the company. It describes severance packages and benefits that executives would receive if they were terminated without cause or if they resigned for good reason. It also covers what happens in the event of a change of control, meaning if the company is bought or merged. However, there is a key point here. In late 2025, these executives entered into modification agreements. Through these agreements, they actually waived many of these severance and change in control benefits in exchange for a cash and stock payment. So, the details here describe the old agreements, but the new modifications have significantly changed what they would receive upon termination. This is a common way for companies to manage their liabilities, especially during financings or structural changes. This table shows the compensation for the non-employee directors in 2025. Directors like Roger J. Pomerantz received fees, stock awards, and option awards, totaling $89,971 for the year. Other directors also received compensation, with amounts varying based on their roles and committee memberships. The structure includes annual retainers for general board service and additional amounts for chairing committees like audit, compensation, and nominating committees. It is common for directors to be compensated with a mix of cash and stock options to align their interests with shareholders. This is always a crucial table. It shows who owns the most stock. As of the 12th of June 2026, Yun Yao is a major shareholder, owning about 37.08% of the company's stock. Sino-Lion Ventures Limited is another significant holder with 34.35%. Then there is Ting Yang and Zhang Yidai, the CEO, each holding about 9.93%. This concentration of ownership among a few large shareholders can have a big impact on company decisions and voting outcomes. It is also interesting to note that the all executive officers and directors as a group own about 9.94%. This part discusses transactions between the company and people who are considered related persons. These are typically directors, top executives, or major shareholders. The company has a policy that requires the audit committee to approve any such transactions if they involve more than $120,000. There are a few interesting transactions mentioned here. For example, there is a consulting agreement with an entity owned by the spouse of a former director, Mr. Ben Tatsvi. Under this agreement, Mr. Ben Tatsvi receives consulting fees, a signing bonus, and shares of restricted stock. There is also an employment agreement with Matthew McMurdo, a former director who is now the vice president of new strategies. He also gets a salary, signing bonus, and restricted stock. These arrangements, while requiring oversight, are quite common when bringing in or keeping talent. The filing also details some financing rounds. In January 2025, the company completed a private placement selling unregistered shares and warrants. Some of the major shareholders like Matthew Joseph Nactra Revocable Trust, Yehuda Shimoni, and Thomas Molick participated in this. This means they bought more stock and warrants, increasing their stake or potential stake in the company. Then in June 2025, there was another private placement. This one involved convertible notes, pre-funded warrants, and regular warrants. Even the then Chief Executive Officer, Jeffrey Meckler, acquired securities in this private placement. This activity shows the company actively seeking capital, often from existing investors or those looking for growth opportunities. Now, looking at these proposals and compensation structures, Indaptus Therapeutics seems to be focused on aligning executive and employee interests with shareholders through equity. The approval of the 2026 Equity Incentive Plan is a significant move that could lead to substantial share dilution over time, but it is presented as a way to attract and retain talent, which is crucial for a small biotech company. The director elections and audit ratification are standard governance items. The related party transactions and financing details show ongoing activity and capital raising efforts. What I'm actually looking for is how this new equity plan will impact future share performance and whether the company can successfully execute its development pipeline with this incentive structure. That is my take. Stay decoded. If you enjoyed this breakdown and want to see more analysis of corporate filings, please like this video and subscribe. All the research tools I use are linked in the description below.